Lesson 3, Understanding Contracts and Escrow, Key Concept Review. First area that we want to kind of review again when we talked about contracts is express contracts and implied contracts. Almost from our very first chapter, we talked about express contracts that are expressly stated in written form or spoken in words. Implied contracts happen as a result of the actions of parties, and that can create a contract as well. So typically, we want express agreements so everybody knows what everything is about, everything's in writing. So you have to be a little careful about actions. Your actions might imply or create a contract between parties. Unilateral, of course, is where only one party is making a promise. Bilateral, two parties. We talked about executory. That's a contract that isn't completed, and then executed, it has been completed. Contract can be valid, they can be voidable, they can be void, depending on if there are or there aren't the existence of the elements that are necessary for a valid contract. So what is necessary for a valid contract? Competent parties and lawful purpose, mutual agreement, and of course it must be in writing. Okay, so those are the things necessary for a valid contract, and that's what the court's going to look at, obviously. When a party fails to perform, another party can sue them for breach. And in a breach, there are certain remedies that the court has in a breach. And we have cancellation, injunction, liquidated damages, rescission, and specific performance. So those are the things that a court can award. Contracts can be terminated in a number of ways. Agreement of the parties, the two parties say, let's cancel the contract. This business of partial performance and full performance is a little beyond the scope of this particular class. Impossibility of performance, that simply means that, let's say the house burnt down. The house burnt down, you had a sales contract on it, it would terminate. Operation of law might be eminent domain proceeding. So after you put a contract in to purchase somebody's house, the owners get notified of an eminent domain proceeding. They're going to take the property and maybe build a road where it's at. That would also terminate the contract. We talked about assignments. We talked about novations earlier. Two ways that a contract can be canceled. Assignment simply means that you get somebody else to stand in your shoes, and now your contract is terminated. Your portion of the contract is terminated. You're not under any obligation. It's the same contract. You just assigned it to somebody else, and then you're released of liability. Novation, your portion of the contract as a purchaser, let's say, is terminated because another contract comes in and replaces you. So your contract has basically been relieved. Employment contracts, we talked about listing agreements. The big deal with listing agreements is that any exclusive listing agreement, that would be an exclusive right to sell or an exclusive agency, which we discussed earlier, they have to be in writing. You cannot have an oral exclusive agency or exclusive right to sell. I suppose you could have an oral open listing, but frankly, they're not even considered listings. By the courts anyway. If you were to sue somebody because they said, I'll pay you a commission if you find me a buyer, and you find a buyer and then they turn around and sell directly to that buyer, you'd have no standing. Open listings are simply not recognized as real listings. So exclusive agency, exclusive right to sell must be in writing. The exclusive right to sell, which is where only one brokerage firm is given the right to sell during that particular period of time, means that if a buyer is found, no matter where that buyer comes from, you get paid. Exclusive agency is a little different. Remember, that's where an owner does have the right to sell. An exclusive agency gives one brokerage firm the right to sell, but the seller retains the right to sell the property themselves and not pay a commission. And they said, as I said, a good example of that would be a builder listing where they have their own sales staff as well. Open listings, or as they say, are just, they have no effect. Net listing agreements are not, in fact, listings. Net listings is really just a way you get paid. It's a method of compensation. Net listing seller says, list my property. I want to net $300,000. Anything after I pay all my expenses, including including any of the closing costs, and if you sell it for more than 350, anything above that you keep as a commission. They are legal, they're just not recommended. Okay, it can lead too much to where a broker might deceive a seller who doesn't really know what the true value of their property is, and maybe it ends up selling for a lot more than what they wanted to net, and then the broker gets an outrageous commission on that. So not recommended. Buyer agency, we talked about buyer brokerage, buyer agency, very similar to seller agency, listing agencies. These agreements must be in writing. And if there's any compensation that the buyer has to pay, which typically in residential deals they don't, some commercial deals might require the buyer to pay a fee to the broker if they find a seller that the buyer wants to purchase their property. So that's any compensation, how long the agreement's going to be, the name of the sponsoring broker, and certainly the names of the buyers that are employing that brokerage company. Very similar to listing agreement, those terms have to be stated in a buyer brokerage agreement as well. Cannot have an automatic extension clause either in listing agreements or buyer brokerage agreements. They all have to end at a certain time. They can be renewed, but that's a separate process. It doesn't automatically renew. And listing agreements and buyer brokerage agreements have to include a clause that say it's illegal to discriminate against anyone, if you will, under those fair housing protected classes that we talked about in lesson 2. Okay, there's got to be an actual statement on those agreements saying that we will not participate in that. In seller or buyer, you can't either. Earnest money deposits. If we're going to hold earnest money deposits as a brokerage firm, it must be placed in an escrow account as soon as the contract is, quote, entered into. And then it stays there until basically closing. There are some times it can be released earlier, but basically closing is when you would release it. Sponsored brokers must maintain escrow accounts, and they're simply going on to say they have to be a separate non-interest bearing account in a federally insured depository. Now, the seller and the buyer can agree in writing to place funds in an interest-bearing account, but it has to be a separate writing, and they have to agree to who's going to get the interest on it. And this typically happens if you have very large real estate transactions where maybe there is substantial earnest money and the deal may not be closing for a long time. Then you might want to put it in an interest-bearing account, but only with the written permission of both parties, and that they one or both of them will either get or split the interest. Interest does not go to the broker that's holding the earnest money. Failure to maintain and take of your fiduciary duty of obligation of accounting would be not failing to take care and proper care of the earnest money. So as we said, it goes into the broker's earnest money account, escrow account, the day when the deal is entered into, if you will, the contract signed, and then technically it stays there until one of two things happens. Either we have a closing, or if the deal falls through, seller and buyer agree who's going to get the earnest money. We never make that decision. We leave it in there until it either closes or there's written direction by seller and buyer. The rules to maintain the bookkeeping rules to maintain your escrow account means that if the department comes in and reviews your escrow accounts, they're going to look for three things basically. They're going to look for a journal, they're going to look for monthly reconciliation statements, they're going to look for a master escrow account log. What are those? One is the journal is basically just like your checkbook journal. It lists every transaction, whether it's a subtraction from the account, it's a payment from the account, let's say a check payment, or whether there's a deposit that's put in. That'll also be in the journal. The ledger is a separate record for each individual escrow account, each individual deal that you have, stating what the escrow balance is per each transaction. And then you have this master escrow account log that lists the bank account numbers that you have, the banks that you're in, who are the signatories for those. And so that we have to have that. In fact, that is actually something submitted to the department when you set up your escrow accounts. So you have to keep that current. And then the monthly reconciliation statement means you have to balance your escrow accounts, the ledgers, the journal entries, and any master account log, which will also show any additional expenses. Maybe the broker's got to pay some interest to because the balance is below a certain amount, so maybe you have to pay some interest, or maybe you're going to buy yourself some checks. Those separate payments would appear under the master escrow account log. So the journal, the ledger, and the master escrow account log should all balance. Sales contracts should include the names of the parties, the legal description, whether or not it's going to be a fee simple estate, or whether or not you're only conveying, say, subsurface rights or air rights. That should be stated in the contract. Any personal property that's going to go with the deal, certainly the purchase price, any financing that's going to be paid, or how the buyer is going to finance it. It's either going to be all cash, or are they going to be borrowing the money from a lender or some other source. And of course, the signatures of all parties. Those are sort of the essentials that all sales contracts should have. Illinois does not have one Illinois state sales agreement. They're actually broken up into different areas of the state. The northern Illinois area has one that they use. Well, the northwestern Illinois has one out in the Joliet area, up in the Rockford area that they use. Joliet has its own contract. Illinois Valley does. And the Peoria area, southern Illinois. So there are a number of sales contracts that are used in various geographical regions in the state. So there isn't one that every real estate firm uses throughout the state. They talk about an as-is clause. Basically, an as-is clause is in a sales contract. The seller says, I'm selling this property as is. All that means is they're not going to make any repairs to the property. Whatever you see is what you get, is sort of what they're saying. Now, just to be sure, with an as-is clause, that doesn't mean you can conceal a defect. Just because you're selling it as is, if there's a defect in the property, you still have to disclose that. All it means is you're not going to make any repairs to any defects in the property. Riders are like mini contracts for very specific deal points. Maybe you might have a rider for FHA inspection, or maybe you might have FHA financing. Maybe you might have a rider for a septic tank inspection. Those would be very separate mini contracts, and those have to be in writing, and they also have to have the blanks to fill in. You can't write your own riders. You are going to have to make certain disclosures, Mr. Seller, lead-based paint disclosures if the property was built after 1978, maybe radon disclosures, maybe mold disclosures, all the responsibility of the seller. and most sellers are going to have to complete the residential real property disclosure report. That's found in your book. There may be one at the end of the book that you're using, and it has 23 different specific disclosures that the sellers are making comments to, either yes or no or not sure. Real estate licensees, basically your job is to sort of quarterback the real estate deal. So if any documents are needed, usually the attorneys and the mortgage companies and the real estate agent and the title companies, they usually work together in getting all of the different documents needed. Your book here says that you've got to get the prior deed. No, you don't need that. You're not going to get a survey. You can get those. You're not going to have to get a certificate of occupancy. You're not going to probably have to get tax bills and buyers and sellers' personal information. What you will need to get is what the last known tax bill was that the sellers were given, in order to make sure that there aren't any other tax write-offs, but property tax discounts that they're entitled to. But you wouldn't really have to go to the tax office. They should have that there. A survey, they're going to make a new survey. Good to have, you won't, but that's not going to be used at closing. A new deed's going to be prepared at closing. A new survey is going to be prepared at closing. And any title defects are going to be reported at closing. And then the buyer will either accept the property the way it is or demand that the seller do something and mitigate those disclosures like liens. Let's just say that at closing we find out that there's a mortgage lien on the property. Well, at closing, the title company is going to want to make sure that the seller has paid that and that lien has been released. And that's usually done concurrently with the closing. So money that should go to the seller at closing, some of that will be diverted to the lender to make sure that the mortgage is paid off. And as far as the sales contracts, we've talked about the elements of sales contracts, what we have to have. The big thing with most sales contracts is that there's this meeting of the minds to form a valid contract. And when there's a meeting of the minds and we have the buyers are of legal competency, there's a meeting of the minds under the sales contract. The sales contract's in writing, and the buyer has the funds to close this. When we have a ready, willing, and able buyer, that's when your commission is earned. Now, typically it's paid at closing because that's when the money is, but you've earned your commission when you found a ready, willing, and able buyer. Continue on to the quiz for lesson 3.